The name of this event is called How to Start a Family Office. And I came to it because I was running a family office panel in New Mexico. We had 65 family offices come out, but also had 3 or 4 others that came out that wanted to start a family office. And they spent most of the day running around talking to people about how to start a family office. And I think they could have used a little bit more guidance on what are the key questions you should ask before you start a family office, if you should start a family office, and thought it might be useful to put together a panel to talk about how do you start a family office. And so that's why we have our guys here today. So with that, let's meet the panelists. First up, we have Eric Sanderson. He's a director at Armanino. Eric, can you tell us a bit about yourself and your firm?
Eric Sanderson here. Thank you. I'm a tax attorney by trade. Been in the business for about 30 years. I formed a family office for a family. I was president of that for a while. Armanino is an accounting firm. It's national, it's full service, and we really specialize in helping highly affluent families just manage the day-to-day of the wealth for the family. So nice to be here, and thank you all.
Great, thanks. Next, we have Kevin Kaylakie. He's the founder and CEO of SinCera Capital. Kevin, can you tell us more about yourself and your company?
Yeah, absolutely. Thanks for having me, Hall. The SinCera Capital formed a little over 4 years ago. I formed the firm as an outgrowth from families just wanting to do something different than they were getting from large RIAs, private banks, brokerage firms. And so I would call our market more of a kind of sub-family office market. We serve a number of single family offices as well, but with those, we tend to have direct relationships with the family members and not the service members, service people within the family office.
Great, thanks. And also we have David Sebastian, founder of Credo. David, can you tell us more about yourself and your firm?
You bet. Thanks, Hall, for having me. So I've been doing my family office for the past couple of years. I've had experience. I have a CPA and a master's. I've worked at Big Four and came out of tax, but I actually fell in love with the family office and how close and intimate it is. And so I do customized services for families, kind of in the mid-millionaire range, if you will, and help people with solutions as to what they need with financial problems.
Great, thanks. So one of the first things I wanted to bring up is when I started looking into the family office structure, what I found is that some believe that unless you have $500 million assets under management, you're not really a family office. Others believed it was a 100 million, some believed it was 50 million. But I was getting a lot of people with $25 to $50 million assets under management wanting to start a family office. And one of the things that was driving the discussion was the 2016 tax laws, or the tax cuts, I should say, are going to sunset in 2026, and the estate tax is coming back on the table. And so a lot of people were looking at the family office as part of their strategy to handle that. And so, but in today's world, I'm not sure you really need to have $500 million AUM to start a family office. We now live in a remote hybrid working world. Fractionalization, remote work enables a lot more low-cost ways of doing these things. And so I thought we might be able to reach a broader audience, and found a lot of people in that category, $25 to $50 million AUM, looking to start a family office, which I think is still relevant here today. But with that, let's go ahead and dig into it. David, what's your take on how big do you need to be to have a family office there?
Yeah, I don't think it's necessarily how big. If you're looking at AUM, I think it's complexity. And when you really start looking at how much you have for assets, how much documentation is produced, you start losing track of like what is happening in my assets, or how many brokerage accounts, what's my cash, who are we paying, what does my cash flow situation look like, are our investments really getting the returns that they need? And I think when you start stepping back and asking yourself these questions, you're starting to realize you need some help. And I see on average, a family office can have 27 advisors. And so you start feeling really overwhelmed coordinating all of this stuff. And not only that, is like everybody getting all the pieces. And so that's kind of where you're talking about, Hall, is the having somebody fractionally who understands this stuff and can help like really advocate on your behalf. So I wouldn't necessarily say it's a dollar amount as much as how good are you at keeping track of all of your information?
Great, thanks. And Kevin, what's your take on that question? When do you think it's a good time to start a family office?
Yeah, I'm in a fairly similar camp to David. Someone asked me, define a family office, and I said there's an office that a family has, and their name is on the door, right? So in other words, my definition of family office is they actually have an office that I can go walk into. They have professional staff. Do they have someone other than just the founder, owner, wealth creator sitting behind the door? That's typically how I define a family office. And so, I think from an asset size, and really it's just an income production size. Do you have the income to justify the expense of having certain people in-house? Or would you rather fractionalize those people and take them in an outsourced relationship? And so really, if you had to put a number, if you had to put the screws to the wall and put a number on it, I think to have a family office where you have a legitimate CEO, CIO, someone from the tax side, I mean, you're looking at 300-400 million at this point. That burn rate can be upwards of 1% of assets under management of the family. And so when you look at that, that's a pretty complex office. It's running with a $3 to $4 million budget.
Well, good. And Eric, what's your take there?
Yeah, I guess you can also look at it on a quantitative, complexity. What are the people that you're going to be hiring? What do you want them to do? I think the 500 million might have come from, 1% of that is what, $5 million. You start getting up to 10 employees and offices and all the equipment and supplies, you're probably going to be paying somewhere around that. If you're at 25 million, that's about $250,000, right? So you might be able to outsource a lot of the services more inexpensively using a multifamily office. So I completely agree. Everybody is different. All the families are different. And maybe it boils down to the question whether you're valuing time or money more. Because a lot of the people who have less than 100 million or $50 million range or less, they're really wanting their time back, and they're valuing their time with their family. So they say, let's just get someone in our lives who we trust and to help us take care of all of the, paying the bills and all that stuff.
Yeah,
great. Well, as I mentioned before in that New Mexico family office panel, one person was running around, asking about how to start a family office. And when I asked him, why do you want to start one? He says, well, I've talked to some people and they say I should. Okay. And so as I looked at it, he was asking people, what attorney should I go get to start a family office? And so I was wondering if he was really prepared to start a family office and if he was approaching it correctly. Kevin, what's your take? What would you think about that situation?
Yeah, I think there's two schools of thought when it comes to who do you go to first. And really, I think David and Eric would be my first choice for a family. I think whoever was intimately involved in the financials of the company or the liquidity event for the family is generally going to have a long tenure with that family, and they're going to know the family well. And the number one factor, the first and most important factor you consider when starting a family office is who do you trust? Who's the person you trust the most? And there's no one better than to run that company. Now, that doesn't always mean that person is necessarily qualified to then start a family office and help them run it. And then so at that point, you go out and seek, someone else who does consulting in that space. We do consulting in family office startups as well. And so you're looking for someone who has been in that background, worked with multiple different types of family offices. Even going back to the size, I know billionaires that don't have family offices, and I know people with $100 million that have family offices. So it really depends on what are the goals of the family. But I would not start with the attorney. I would start actually with the tax person, or the CFO from the company is generally going to have the best knowledge of that family and what goals they want to accomplish.
Great. And Eric, what's your take on that question? Where would you start?
Yeah, I agree. That's certainly how I got started. The family.
I saw you nodding.
They had some. That's right. They had some operating businesses. So I think a lot of these family offices, are born out of the operating businesses that made the family wealthy. And those are the people that they've surrounded and trusted. And that's sort of how this family, and I got hired as the head of the tax and legal departments. And that's really where, because, your friendly neighborhood field agent for the IRS. I mean, you're basically your partner in every business transaction. So it's a really important thing to align your taxes. And then in order to do that properly, you really need to align, what are my assets? What's my net worth statement? What's my balance sheet look like? Where is all this? How do you consolidate all this stuff? And from that point, I think the main question when you're looking to start a family office that you have to ask yourself is, what do you want them to do? Every family is going to have a different answer to that. In our case, we had, private jets. So I ended up managing the flight department and the mechanics. That was something new. We had a huge ranch and we turned it into a huge ranch development. That was a pretty unique skill set. We had a full stable of operating business. So we had M&A department, and then we had a full tax and accounting department. What did I leave out there? Investments. So, we outsourced all of our investments, even though we had over 30 people in the family office. A lot of people are going to say, well, I really want someone in my family office to run my investment because I don't want to pay investment management fees. I can hire someone cheaper than what I would pay and stuff like that. But so I think that's the main focus when you're going to start it. If you're going to start one, who's going to be your first hire?
Good point. David, what's your take on that?
Yeah, I think you start realizing that there's so much data to keep track of. It winds up being, oh, I need somebody to pay my bills, or I need somebody to pay my tax bills. And it's, well, I need somebody to move money for me. And I think this, like Eric had said, it can come out of the business, the family business. I also see it coming from an executive assistant. You could have somebody who is your right hand person who you give everything to. But sometimes that person can't necessarily handle all of the moving money, and that's just not their skill set. So then it can be having a CPA coming along beside that person to resolve all their problems while they're putting out fires for the executive. I can also see it coming as like a fractional CFO too, where it may not be you need a full-blown somebody sitting on you full time. Somebody can just step in and fill in the gaps kind of ad hoc. And so like Kevin was saying, having a full CIO, a CFO, I mean, that sometimes feels really daunting to come in and bring in that piece. But you can have somebody who's really just that main point person to help coordinate that. So I don't think you need a legal setup for that. It's just you need somebody that you can trust to help you navigate all these questions and things that keep coming up in your financial life.
Great. So we talked about some factors for starting a family office, but what are the other factors that may come into the decision process? If you had to list them out, what do you think else? What else should we be looking at? Eric, what would you put on the list there?
Systems. I think doing a system analysis before you start when you set up a family is really important. What are you working with now? And who's comfortable using that? And is that the right, say, tech stack that should be in place moving forward? Because, we're certainly in the information age, but I don't know about you, but I get a little nervous about where is my information? How do I get it back? My computer crashes, my phone crashes, and all this stuff. How do you reconsolidate things? And then the last thing I'll say about it is, it's also in the continuity of the people that are there. We're working with a family now, hundreds of pieces of commercial real estate. Well, the gentleman who had been running their family office for 40 years just retired. The encyclopedia of knowledge is gone. And how do you make sure that you're capturing that? So step one for me is the systems analysis.
Great. David, how about you?
Yeah, I'd agree with that. I don't think that the wealth issue goes away. So do you deal with it now or do you deal with it later? And oftentimes if it's dealt with later, it is on your kids to deal with. I was talking with a girl the other day. She's 28 years old and she's like, this is our lot. I either fix the problem now or I fix it later when you guys pass away. And I think having a process in place, and that's really what you're asking for in family office. How are things being saved? How is information being processed? Who has access to that? And in Eric's comment there, when you have somebody who has been sitting with the family for years and years and years, how do you extrapolate that data? And lucky for us, I think in the technology age, it's fairly easy to get this knowledge from folks and to make a really smooth transition, to create a robust process, and to get some really strong automations in where you can cut down the time and the data entry from the family office.
Great, thanks. And Kevin, what's your take there?
Yeah, I mean, almost identical. I think there's really three things that every family office wants, and in particular, and they want it in this order, and it's clarity, confidence, and control. And clarity comes from good systems, good tech stack, good reporting, the ability for not just one advisor or not just one family office employee, but all family office employees to be seeing the data that they need to be seeing to make decisions and to get things done. I think what I see in a lot of family offices is they have employees that don't have the right tools and data to actually get things done. And the family gets frustrated with them because they feel like they're not doing anything. And the reality is, if they had good systems and good clarity and the proper data, they could solve a lot of problems for the family members that they would never have to face. And so ultimately, they all want some level of control of their assets. They're used to owning a business. Not all of them are there, but of the first generation wealth are used to having control. They're used to being able to cut back, on financials and move the company money around. And when they become more of a passive investor, that's not the case. And so the employees need to be more dialed in. I would also say the second thing is family dynamics. So if you actually have a real multi-generational family, family dynamics can be a wonderful thing, and they can absolutely explode a family office if not handled properly.
Great. Well, if anybody in the audience has a question, please feel free to post it in the chat box and we'll pick it up. Well, we got our first question already. How well do fractional CXO roles work? Given the split responsibilities, don't they run against the ethos of a family office? David, you want to pick that up first?
And CXO meaning CFO or CEO?
CFO, CTO, legal, etc.
Yeah, I'd say that when you're working when I'm working as a personal CFO with somebody, I am working on their behalf all the time. And that means that I am unbiased with other advisors, and I'm always putting that family, working as that fiduciary on their behalf. So if we have an advisor that I'm working with, or that the family's working with, and I see that they may not be doing a good job, I let the family know and say, hey, look, I've worked with other guys who are probably better than this. And that's always my my idea of when I'm looking at this. This is your information, and I don't want to give my biases on this as much as like just letting you know what is available for you, what information is yours. And I want you to make the best decision possible for your wealth. And oftentimes I'll give families the scenario A, B, and A may be more efficient, but they choose B. And like, that's great. You choose B, and we're going to run with that the best that we can. And that is, I think that's the position that I always like to take with the families.
Great. Kevin, what's your take about fractional roles?
Yeah, I think it's the same thing. Whatever you're hiring there, you're looking for a fiduciary. Is the main role. You're looking for someone who's legally obligated to act in your best interest. Better than that, find someone who's wired that way. So, and the only way to really do that is ask your network, ask other people, spend time with individuals. Then you can find the people who are actually wired as a fiduciary and not acting in it legally just because they have to. And again, you talk about the ethos of the family, that also goes to more family governance discussions. One of the greatest honors I've ever had is when one of my families reached out to me and asked me to help write their family constitution. I thought I couldn't have been asked for a greater honor than that. And so once you help a family do that, you're a part of the ethos, not going against it.
Great. Eric, what's your take?
Yeah, I think they have their place. Armanino certainly provides back office CFO services on both a temporary and a permanent basis, CIO services and other types of things like that. So I guess it depends on the ethos of the family, because the difference between, say, hiring Armanino, you're hiring a firm, And the people in that firm are probably going to be interchangeable and move around a lot more. If you hire that person directly, which is a family office, you're the employer. You have a W-2 employee there, and you'll have to be managing that relationships as well. So, that's great when you pick the right person. It's not great when you don't. And I think Kevin brings up a great point. When you look at family dynamics and family governance, build in the ethos of the family. It's one of the best decisions I made running a family office. We need to have family communication. We need to be defining who knows what, when, and why, and plan for those communications. Because invariably, as the generations expand, factions are formed within a family. And the advisors can really be caught in the middle, and you can also be caught off guard. When someone comes with you with what seems to be an innocuous question or request, it really chafes off someone else in the family, and the next thing you know, it's coming at you from both sides. So, so thank you, Kevin, for bringing up the family governance and dynamic aspects of that.
You bet.
Great. Well, I've talked a little bit about tax advantages and why that's driving some people to it. What would you say are the big tax advantages of a family office structure? Let's start with you first, Eric, and get your side of it.
Well, it's in the control aspect, and it's knowing what's going on. We were able to manage our tax exposure and tax risk pretty significantly. We had an internal tax department. When you have dozens of moving parts with investments and companies you own, and then using assets in those like airplanes and yachts, and then unrelated to business things like ranches and things. So much of your risk from tax is things that fall through the cracks. So having a good system to capture all of that, and it, Armanino, of course, are a big tax firm. I'm a tax person. So, working with families to get data is sometimes challenging to be on the outside. And if you don't get the right data at the right time and something falls through the cracks, this gets picked up by the IRS computer system. Next thing you know, you have an audit. Before I got with the family I worked with, there were 7 audits going on. And that's one of the reasons why they brought me in. It's like, hey, we got to get this stuff cleaned up. And we did, and we were able to organize things in a much more tax efficient manner.
Great. Kevin, what's your take about that?
I think from, again, going back to our clarity, our original organization of data, having the data come in on both the investment side and then flow through into the general ledger is an extremely important aspect to getting taxes right. And as Eric said, sometimes it's the surprises that get you in those situations where, sometimes someone gets a wild hair, makes an investment that they don't tell anybody about, and then it shows up and then you have to handle it. But most of the time it's, if you organize that data, if you have the right systems and you move the reporting into the final system, whether that system sit on a GL bridge from an investment side, or you just have it or sits on a general ledger system, or that you get it into the general ledger system, it's the ability to do that. And then I think the second step to that, again, is having advisors that work well together. You have to have advisors that can talk to each other, and you don't want to silo them off.
That's right.
Great.
Yeah,
David, what would you add?
I'd echo that with Kevin too, where tax oftentimes just needs information and data, but then who is managing that day-to-day operation, asking the question like, should we sell, should we buy? And how much do I have in passive income versus how much do I have in active? Is there any kind of investment that we can do today to decrease those taxes in the future? Having that data coming in and knowing how much money you're making can be very, very valuable. And then that is looping in the tax folks to say, hey, look, here's what's going on. We're making a lot of money. What do you recommend? You guys have the depreciation schedules. You guys know what our deductions are. You know what our NOLs are. How do we organize, like, how can we be more tax efficient? And then they are able to take that information and really do some robust planning.
Great. I have another question from the audience. Is it typical for a family to have and operate under a family mission? how difficult might it be to bring employees or outside fractional advisors along in that approach? Kevin, how would you answer that?
Oh, man, when you use the word typical in family office, you just roll yourself back to the old statement that if you've seen one family office, you've seen one family office. I think when you start to see multi-generational wealth involved in the family office is when you see the development of family mission statements, family constitutions, and very structured philanthropic strategies tend to come about at the second generation. Often they're used to bring in second generations. Now, from the employee perspective, yeah, maybe this is a little sharp elbowed on my point, but the family offices that I know, they don't care if people don't agree with their mission, right? They're going to find people that do to come work in the family office. They're not going to find people that don't.
Right. And David, how would you handle that?
Yeah, Scott, that's a good question. I say that most of the families I work with do not have a family mission. And how I see is the baby boomers normally aren't really talking much about their wealth. And the millennials are like, hey guys, let's talk about this. Let's create a mission vision, and they're like, we want to do ESG investing and all these kind of things that are different with the generations. And that's where it just becomes almost like a conversation of, hey, what is it that we're trying to do? I mean, can we even start there? And then as far as a fractional advisor fitting into that, I mean, personally, I work with clients who are extremely, if we're to say they are extremely liberal in their beliefs, and that drives a lot of their decision making. And I have families that are extremely conservative. And I have families that are of faith, families that are not of faith. And I think as the advisor, it's going back to you're just providing them the information they need and helping them like understanding who they are as the individual, trying to draw out really what they're trying to achieve to give them the best results. And so if I can like sit in their shoes and to really help understand like how can I best serve this individual, and that's really what it comes down to. And it's not really what my bias is as much as how can I better serve the family.
Right. Thanks. And Eric, what's your take?
Yeah, I don't think it's as typical as it should be. I do think family mission is super important, and unfortunately, it's the exception that I've seen in many of these families. So a lot of the problems come later. Relationships start to fall apart because unspoken expectations today are tomorrow's resentments. In a lot of families, they find a hard time getting along. Money is often a taboo topic, particularly for these first generation wealth creators. One of them said, hey, I want to give my kids the best gift that my parents gave me, and that's the gift of nothing, and keep the money, he says. So, there are some things that you sort of have to work through there. So a huge part of my career, I've facilitated dozens of family meetings and family retreats. I came up with a process I think worked pretty well with them, and it really started with communication skills. You have to get away from a lot of the family assumptions, and we really start to get people talking and get to know the real people, behind their reputation within the family. So I think it's hugely important, and I think it's become more and more important. As a lot of these, family offices we're seeing now are born out of, post-World War II types businesses, and, those families generations starting to sunset. And as we expand in the second, third, and fourth generation, they need to have a plan to communicate because they have to work together.
Well, that's great. We had a comment in the chat box. Would family office be a good Netflix binge? I think we're talking about a Succession style show there. What was your take on Succession? How do you think that was like or not like a family office you've seen before? Kevin, what's your take there?
Oh, I admittedly didn't watch the entire series, but saw it in bits and pieces. Obviously slightly over dramatized, but I think the concept of the issues are not unique, which is why they rung so true in the series.
Right. David, what was your take on Succession? How do you think it was similar or not similar to the family offices you work with?
Yeah, I think it's dramatized a bit, but to be honest, when I'm watching shows like that, it feels like work. I mean, I've worked with, interesting families who don't like each other, families who love each other, and everywhere in between. And that is just the human emotion, and money is just a factor of that.
Great. And Eric?
Watch Netflix. No, I'm kidding.
Just watch Netflix and you'll get the same thing.
Now,
Great.
it's one I should watch. I've been said I auto watch, but yeah, like David said, it kind of feels like work sometimes. I don't really watch, any legal shows either, because I sit there and watch. I'm like, no, that's not what you do. But yeah, so, but I understand the show. People talked about it, and it can get pretty nasty. I sort of had to deal with that in the family I worked with. I had to go back and do a little bit of forensic history and piece some things together. There's this really toxic message that had come from a certain place that happened a long time ago, and it was just misunderstood. It was blown out of proportion. It was wrong. And once we were able to find the facts, we were able to kind of cool the jets on a lot of that stuff. So again, I go back to the need to communicate in an environment where it's safe to communicate, and that's why facilitated conversations are super important.
Yeah.
Great.
And I would say, if in the family office world, if you want to go back and watch a series that'll make you laugh, watch Silicon Valley. That one, if you've ever worked with venture capital, that one will make you laugh till you.
That was a very good take on it, I thought.
Yes.
So for the audience, we have time for one or two more questions, and then we'll move to our pitches. And my last question is how well does a family office structure facilitate succession planning? I see a lot of businesses going out of business because they can't get anybody to pick it up and they don't know what to do. And with the family office, it seems like they're trying to make that into a longer term, multi-generational thing. Eric, what's your take on that?
Well, you have to put in the effort to do it, to be multi-generational. Now, I've always been surprised. We can do a lot of planning and people talk the game, up to, but then, when you're challenged with the business decisions, the family decisions, you just don't know. So I've seen people rise to the occasion. I've seen people fall down. So that's why I think it's important to have you can't have a fragile system in place that's just dependent on one person being super successful. I think you need to have a more agile organization that can facilitate, because when maybe I put it in this context, many of the family members I work with, first generation wealth creators, they tell me what they don't want the money to be used for. So a lot of times they don't want the kids to, certainly they don't want them to need the money, because they wanted to make something on their own. They don't want them to want the money, otherwise just kind of always, have their hands out something. And a lot of times I didn't want them to know about it. I asked them a simple question: well, what can they use the money for? And I think if they can answer that question, then family banks start to become logical, or some multi-generational trust planning type things, liquidity type of analysis. Those things take on different meaning within the family, and they're ready to consume those type of data points.
Great. And David, your take?
Yeah, you can have the best best processes in place. And to be honest, I've worked with some of the best lawyers, and we have everything set in place. And the wealth rarely transfers to the third generation. I mean, it's less than 5%. And that's because there's a lack of communication and a lack of learning with G2. And so if you start in those two places, that's a huge start. And, then all of your communications wind up flowing how it's actually going to go with the transition to the next kids. And so as your family grows to the next generation, if you don't have somebody in G2 or G3 who's willing to handle be a centralized place to handle all the documentation, that's really where you need somebody to help you out, to help everybody be the glue as to what's going on.
I see. And Kevin, how about you?
I think he's referring to shirt sleeves in 3 generations as a common theme that we hear in the family office world. I think it goes into, I've worked with G2, G3 family members that will look at me and say, it's not my money. Even after the parents have passed, it's not my money. I want to do what mom and dad wanted to do with it, or what grandpa wanted to do with it. And then I've worked with families that are the opposite, right? They couldn't wait to get it and do whatever they wanted with it. And I think it starts at that. You have, as I think Eric was alluding to this, is the reason the family constitutions are important, or family mission statements are important, is so that the family is very clear on what mom and dad wanted. Is don't leave this world and not leave instructions behind, because that's almost the greatest train wreck that can happen, is give them something and give them no guidance on what to do with it. So, but Eric, again, to your point, actually give them guidance. Don't just tell them what they can't do with it. And those are the families that I see have far more success continuing wealth through generations.
Great. And our final question today, and then we'll have a few pitches, is any advice on an MVP structure, minimum viable product, and systems for a budding family office to bring clarity fairly quickly? How would somebody try something out to get going on it? David, what do you think?
Yeah, so I think for just the basic, you would do, I'm a very practical guy. I would get into a accounting software, QuickBooks or Xero, something small like that. You have somebody reconcile your accounts, so at least you know what you have on. Try to get a net worth statement. That's a place to start. If you're cutting a lot of checks, it's great to have a system or process in place. I normally get like an evergreen email going, so that could be your family name at yourbusinessdomain.com, and you just start creating all of the information going to one spot. And then from there, I have a password manager for families. I'll use LastPass or OnePass, and then basically families can share passwords. So if you or somebody in your family passes away, at least they can access all this information. So like those are just kind of like very bare minimums of starting a process for the family office. You're on mute, Hall.
Kevin, what's your take?
Yeah, I think that's that's definitely a great starting point. Multifamily offices like myself, those are the systems we built in place to bring all of those things together, from investment reporting to accounting to bill pay to getting those all of the information into the system. I don't think it's an MVP structure, but if you have more of a complex entity structure, you'll need something like a Sage Intact or some sort of really cool system in QuickBooks to help you embed and consolidate that reporting. But yeah, I think you can really scale efficiencies in an MFO structure rather than doing it in-house. And that's really why firms like mine exist. Very
good. And Eric, what's your take there?
Yeah, Armanino has a strategy and transformation team that can go in and assess the technology that's in place. So huge radical shifts from where you are. Those could be hard to digest, or maybe there are strategic moves to upgrade certain things. Kind of the tech stack that we like for larger family offices, like Adapar, so the data aggregation software. I like Sage Intact as your accounting software. And then we work with another program called Knowledger that helps link those two together so they communicate very efficiently. And one thing I like about the Adapar piece is families, they can create a custom dashboard for themselves. So I've always noticed that different people are looking for their number. It's a different number. It's my cash today, or it's my value, or it's my return, or whatever it is. You can customize that tax dashboard. And that's a process that you can work with advisors and the other family members together, and you can start, again, facilitating communication while you're putting together a system that'll work for the family.
Yeah. Very good. Appreciate that, Eric. I want to thank our panelists. We're at the end of our content piece. David, Kevin, Eric, thank you for sitting on the panel today and providing such great feedback to the questions and the answers you gave. If anybody in the audience would like to talk with these guys, we'll be glad to facilitate introductions afterwards. Just let us know who you'd like to follow up with. And with that, we'll go ahead and close this portion out, and we'll move to our first pitch. We have with us today Chris Casper of Techless. With that, we'll have Chris put his slides up and give us a short presentation about what he's doing there as well. Thank you, guys.
Awesome. Hey, before I kick it off, just want to thank you guys for what you're doing. I can tell you candidly, I'm a 5th generation small business owner. So we've made it past the statistical anomaly, and the whole thing about mission, vision, value has been super important for us. So thank you guys for what you're doing. People like you guys have helped us navigate some extremely complicated legal, tax, and philosophical family stuff. So thanks. All right. Well, I am here to talk to you guys about Techless and a phone that we make called Wise Phone. So before we kick it off, high level, Techless, if you zoom 1,000 feet off the ground, we are here to create healthy technology. People are craving for something healthy, but they're not even sure exactly what that is. So we're here to build it. If you look at the world right now, so many people are squandering their lives on screen time, watching cat videos and makeup tutorials and all this stuff. But we are here to actually give that time back to them and reclaim those hours. And we're calling them life hours. This is time for people to spend in real life. When I initially made this product, our phone was designed to be for kids, but we quickly realized that this was the tip of the iceberg. A Deloitte study this last year said that there's 164 million people that are trying to cut back from their smartphones, but despite them trying, they can't. And we have to ask ourselves the question, why can't they? When it comes to kids, where we initially looked at, the statistics are just staggering. I could go on for hours about this, but high level, since pre-smartphone, suicide rates have gone 4x. There's direct correlation with what is in the kids' hands and mental anxiety and depression. Parents are super worried. We got a survey from over 2,000 parents. All of them are worried about the things going on these devices. So why doesn't big tech snap their fingers and solve this and make some healthy things? And the truth is that they built themselves regrettably upon the attention economy. Apple and Google, this is the revenue from their app store alone. This is the money that they get from your eyeballs on screens. It would be illegal or fiduciary irresponsible for them to put boundaries around this stuff. And so there's very little innovation in creating things that's actually healthy for people. And I mean, I heard an internal quote from the CEO of Google, and he said, "We made a mistake when we made the internet free." And so there's definitely they're stuck. They can't do anything different, which leaves opportunity for someone to come in and doing something totally drastically different. So we went on the far other end of the continuum from a fully functional, full-fledged smartphone and started with something very minimal, very pure, very simple, and created Wise Phone. We own the OS from the ground up. There's no Google or Apple reporting. It's a collection of 8 independent tools or apps that we've made, along with a back-end portal that has very robust reporting and statistics. I hired an ex-Google product manager to help us define what our next-gen phone is looking like. We've sold this for a couple years now, and consistently he did intensive user interviews, an hour plus with lots of users, and consistently people love Wise Phone for simplicity, but more importantly for what it wasn't. They were actually paying a premium for the boundaries on their device. What I get excited about is we are actually living out our mission, which is we are helping people be more present, more focused, have those feelings of freedom, and they feel like are actually living out the life that they were hoping to do and not being distracted by their phones. Categorically, we are in the minimalist phone category, have emerged as the best phone to use. If you look, people buy 5, 6 minimalist phones, they use ours. Ours is the favorite here. Customer satisfaction is off the charts, 99.96%, and hundreds of really good reviews. And what I'm super proud about is that so many companies can make something, sell something, throw up some flashy numbers, but they do it at the cost of long-term growth. And our brand is the greatest predictor of how well we're going to be doing 5, 10 years from now. And we've got a 61 net promoter score. This goes from -100 to +100. This is benchmarkable. We're doing better than Chick-fil-A, Google, Target. Really, really strong brand loyalty here. To date, We in the Silicon Valley world are fairly scrappy. We've only collected $2 million in investment so far, and we've thrown up over $1.5 million in revenue, sold 3,000 phones. This isn't like crazy numbers, but simultaneously, this is a tremendous amount of traction for the capital that we've put on. So as I mentioned, this is WisePhone, minimal phone, but we're at this really cool precipice where we're kind of, the master plan is coming into action, where we asked, hey, we wanted to start with this, something we could technically pull off, but we are working on something more ambitious. So right now we just opened up pre-orders. We've already sold a few hundred of them. We are making WisePhone 2. There's some massive philosophical differences between these. I'm sure if you're looking at the call and saying, hey, could I use WisePhone? The inconvenience hurdle is a little bit challenging for all but a few people that claim to be digital minimalist. WisePhone 2 is a breakthrough in the sense that we will have a handful of other third-party practical tools. So it is a healthy phone, not a minimal phone. This appeals to that 166 million Americans that want something less capable than a full-fledged smartphone, but a little bit more than what WisePhone is. So some major breakthroughs here. There's some major improvements. When it comes to hardware, we're doing super good. We have 58% gross margin. This is unheard of in our industry. And the cool thing is our profit 4x's once we switch to WisePhone 2, because we're bringing in a subscription service. We're also working on carrier services. If you take a quick snapshot at the landscape, most minimal phones are really hard to use. Most people think they can lock down a smartphone, but at the end of the day, you actually can't. It keeps sucking you back in. You keep reinstalling apps. It's just not quite geared to empower the will of the users. Kids phones, we play in that space. 25% of our phones are sold to kids, but at the end of the day, kids don't like kids phones. So we've specifically branded to not be exclusively for kids, even though we're safe for kids out of the box. There's a very niche group that likes $1,000 plus privacy phones, but the broad American market doesn't care. And people think flip phones are safe, but they're actually not. But I'm personally excited because there's this huge resurgence of Gen Z going out and buying flip phones right now. And that's good for us because we are an amazing alternative to a flip phone and actually what they're looking for at this moment. Regarding leadership, top two, I'm a branding guy. I've built a product that crossed $1 billion, or actually a brand that crossed $1 billion in sales about 7 years after launching. And this year, this is probably 10 years after launching, we just crossed $1 billion this far into the year. So in a high trust industry. And so kind of repeating that here. I had an ad agency prior to this, and John Messer is our chief product officer, chief tech officer, and he was a product manager at Google and also created a product that brought in over $1 billion in revenue year one after launching it. So we've both done some extremely large initiatives, and I think the combination of us and our great working relationship, we have some pretty cool stuff here. We have yet to really advertise or market this thing. I hop on podcasts all the time, but 85% of our growth is organic. And this next year we have a plan. I'm not going to go into all the details, but we think we can 4x sales easily in this next year through affiliates, which we haven't done anything like this. We have yet to have a full-time marketing person, but we're diving in this next year. High level for raise, historically we've raised $2 million. Right now we're raising $1.5 million right now. Currently, we just secured a lead investor and have about $1 million of follow-on investment already in queue. So we are hoping to close this probably within the next 30 days. So term sheets there, we've accepted a couple checks, and we are looking for investors. And last but not least, everyone's talking about the problem, the social dilemma. People are trying to regulate social media and everything going on right here. There's a lot of people complaining. There's not a lot of people actually building solutions. And so we are really, truly one of the few companies out there right now that's being proactive in this. And we're thinking different than the rest of the world. So happy to answer any questions.
Yes, if you have questions, please post them in the chat box. My first question is, what's the valuation on the current fundraise?
Yeah, so our last valuation about 18 months ago, we did a price round and it was an $8 million post-money valuation. This raise right now is a convertible note with a standard, 20% discount. And we are already talking with investors to lead the next round, which is going to be priced. And I don't know what the valuation will be there. We're letting the lead determine that. But we have an $8 million benchmark 18 months ago.
And what's the proposed exit you're looking for here?
Yeah, so actually some exciting news. We actually got an acquisition offer yesterday, which is pretty cool. So we probably won't take it because we have a tremendous amount of value to unlock in the next year. But we are looking between 1 and 5 years of being acquired by either a carrier or a value aligned organization that values the platform level control that we have because we are not connected with and depend on Google, Apple, a lot of the other companies. We have our own independent tech stack, and that is of high value to a handful of organizations that want that platform level control.
Great. My next question is, how many more rounds of funding are you planning to raise after this current round or set of rounds?
Yeah, so we will hit profitability very clearly. We have to sell 1,000 phones a month, which is not hard to do. Without trying, we've been selling 250 to 300 a month. So we're going to hit profitability after this raise and intend on this price round near the end of the year, maybe shortly afterwards. And that is all that we need. And it is really up to the board of directors, which is comprised mostly of our lead from the last round and this round, to determine exactly when we will exit. But 1 to 5 years is kind of the target range for us. So
great. And what OS are you using on this phone? Is it Android?
Great. The fun thing about this is we made our own OS. That was not easy to do. We actually took 18 months before we went to market selling this thing. It is a fork of Android, but it's years old. We've de-Googled it. We have our own app distribution platform. Really technical, Herculean project, I would say. And so we call it Wise OS, and we own the code, which is amazing. So
what's the technical advantage of having your own OS? Why did you not just take a standard off-the-shelf Android?
Yeah, so there's only 2 operating softwares that are primary in the world, Android, iOS. One of my early advisors was Josh Benko. He was the guy that created the Apple iPad. And I just asked him, hey, could we do what we want to do on an iPhone? And he laughed. And that was the end of that conversation. The amount of control that we want is not possible on iOS. When it comes to Android, one of the things that we really value is transparent relationships between individuals as well as privacy. And Google has buried so deep into Android things that are in direct conflict with that we cannot use stock Android. And there are vulnerabilities. And so there's some other organizations that have done what we're trying to do, but they do it above the OS level, and their trust scores are declining, their user bases are declining because there's ways to circumvent the protections that they built in. And so like an example is we have a messaging app. And we believe that parents should philosophically be able to see what kids are doing on their messaging app. Google takes a different perspective. They believe that kids have a right to privacy and that parents do not have the right to see what's going on. So for philosophical reasons, we could never publish that messaging app through the Google Play Store and provide that service to parents having insight into what's going on with their kids, even if it was guarded or there was machine learning, and only if it was a kid mentioned something suicidal or received a sex message. That's a moment where we think it would be wise for parents to know what's going on. And so we had to get that level of control in order to build what we wanted to build.
Great. And what are your primary sales channels? Are you online? Are you in stores, or both?
Yeah, so currently we sell exclusively on techless.com. We actually have one carrier that is we just signed an agreement with them. They're going to have Wise Phone 2 on their site. And I think we might have some other distribution partners through there. And we have an extremely strong affiliate program. So there's some very, very passionate people that love what we're doing and they promote. But currently it's techless.com. Wise Phone 2 is a distribution worthy product. Wise Phone 1 was not.
Great. My last question is, what do you attribute your high net promoter score? Is it good product design, or is it good training, or is it good service, or all of the above? But what do you think is the secret sauce there?
Yeah, so in our industry, we're not selling a phone, we're selling trust on so many levels. That's what we're selling. And I think just a combination, and previously the industries that I had sold in were precious metals, firearms, a handful of manufacturing, especially manufacturing things. And it was a similar statement. And the reason why these companies succeeded was because we established both business practices and marketing language that built trust. Precious metals is a semi-shady industry. A lot of people have been screwed. Well, we built in policies that says if we don't have the precious metals, we're not going to sell it. And so that was a trust building initiative that cost the company lots of money. Well, we've done things like that within Techless to build trust. We've taken very countercultural stances on things. We've very outspoken on some of the exploitation in the industry. And that's just, that alternate voice has been something that the world's hungry for. So
Great. Thanks so much, Chris. And for those in the audience, we sent a poll. For your interest, please check it there and we'll provide you more information. Thanks so much, Chris, for that great presentation. And now comes our next one. We have SAPS by Jordan. Jordan, if you go ahead and launch your slides and share your screen, let's pick up on your product.
Great. Thank you, Hall. Thanks for having me here today. Excited to be with y'all. My name is Jordan Wilson. I'm the CEO of SAPS. Let's dive in. So what is SAPS? Studies have shown that 80% of the American population is dehydrated. And the healthy options out there to address that problem are pretty limited when you look across the spectrum of electrolyte drinks. So let's go back in time a little bit to when Gatorade was created back in the 60s. That product was built totally on function and actually working. Now, years later, mass market brands are pumping this stuff full of artificial flavorings and colorings, crappy ingredients, tons of sugar. They're not really what they're supposed to be or what they were initially created. So SAPS is really kind of going back to the roots of sports drinks with a well-rounded 1900 milligrams of electrolytes, no added sugar and other functionals. It truly can solve this problem of clean, healthy, effective hydration. So who is our customer? Our customer are the physically and socially active individuals. Down here in Austin, where it is blazing hot right now, these are the people that are going for runs after work, maybe going out for drinks, happy hours, they're cycling, they're getting outside, they're moving their body. They're aged 20 to 40. These are the people that, they look at products on the shelf and they want to buy stuff that they can trust, that they're looking at the nutrition panel and seeing what's on the product, making sure they're not putting anything into their body that's unhealthy. If you look kind of across the spectrum right now in our space, these products don't align with a massive customer base that's looking for stuff that's relatable, that's not pumped full of sugar. So Gatorade, mass market brand, they realized, hey, customers are looking for more electrolytes in products, and they launched Gatorlyte a couple of years ago. This product still has tons of added sugar, not that many electrolytes, and still bulky plastic bottle, artificial flavorings and colorings. You kind of go down the list, electrolyte, body armor, Prime is a new entrant. All this stuff looks the same. It doesn't function well. It's got questionable ingredients and it's not healthy. So SAPS, 0 added sugar, 35 calories, 20 different functional ingredients, and we're in a can. It's a huge differentiator for us. So what is actually in our product? First and foremost, it's hydration. 80% of our drink is coconut powder. And so we're pulling natural minerals, natural vitamins, our natural sugar from that base of this formula. On top of that, we're supplementing with additional magnesium, calcium, additional salt to make sure that you are getting replenished what you're losing from a long day outside or working out, et cetera. Beyond hydration, we've got stuff in there for muscle recovery, inflammation. We're using functional adaptogens for just daily wellness. And then last but not least, we have stuff in here for overindulgence. If you've had too much to drink, there's great liver cleansers and detox ingredients in our product. These are all the reasons that people are buying these products off the shelf, and we've kind of packaged it all into one with SAPS. So we've sampled thousands of people at this point. What we're seeing really resonating with customers are these bullet points, which are 1900 milligrams of electrolytes. That's 5 times your standard sports drink. No added sugar, 35 calories, no artificial flavorings and colorings. And lastly, we're Whole Foods compliant. So currently there's only one other brand in our space that is Whole Foods compliant, meaning they don't have any banned list of ingredients that Whole Foods doesn't allow in their stores. This is a huge differentiator for us and is going to play into our growth. So just looking at the market as a whole, across beverage the last 15 years or so, you've seen different segments blow up over a period of time. So sparkling water had its moment, energy had its moment, alcoholic seltzers, etc. We're in that moment right now with hydration. So last year, a big study was done asking customers, what is the number one function you're looking for in beverages that you're buying off the shelf? Hydration was the number one priority that customers are looking for. The space is growing over 10% a year right now, is expected to almost double by 2030. The crazy thing is that Gatorade still owns 70% of market share in this space, which tells me that there is plenty of opportunity for new entrants to continue to just chip away at that market share. I am very bullish on this space. Obviously, I'm biased. I know there's going to be some winners in this space the next 3 to 5 years. And because of the way that we're differentiated, we can be one of those winners. We wanted to make sure as we're building out this company, we have a team of people that have done this before, because it is a hard competitive space. Myself, I was a part of another hydration brand called BioLite. I was employee number 3 and COO there. And while I was there, we grew the brand from 1 to 18 million in revenue over the course of 3 years. 2 months after I left the brand, Anheuser-Busch actually approached them about acquisition. Mike, my VP of sales, was one of the founders of Lone River Ranch Water, alcohol brand that blew up overnight. They actually sold that brand in 12 months to Diageo for $100 million. Outside of Mike, we've got other individuals that have been a part of growing other hydration brands that have done this before. This isn't new to us. So we launched with our distributors in March. Benny Keith is our distributor for Texas. They cover the whole state for us. We're also working with Lippman in Tennessee, who also covers the whole state for us. We're following a very similar playbook as what Mike did at Ranch Water. That's why we've chosen these distributors to focus on specific markets, work with a regional distributor who understands those cities well and really can go out there and sell. What we've seen so far with Benny Keith is just massive success in stores like Central Market and other small independent stores where people are looking for healthier options. So in Central Market, we actually got authorized to sell the product. We sold out within 3 days. They've now moved us to the functional beverage set. They've given us 6 different facings, and we're continuing to kind of move volume in that store. In Tennessee, we recently got a test run with 5 corporate-owned 7-Eleven stores. Once that goes well, that'll open up the door for over 100 different 7-Eleven locations in Tennessee. So I kind of already talked about where we're selling right now, but where we're aiming to sell. So we are entering really an important season for the brand where all these buying cycles are starting to happen for different chains. Whole Foods buyer has reached out to us. They're really interested in the brand. They're currently reviewing, and we should hear back from them in the next couple of months. We're in talks with H-E-B, Kroger, Albertsons, etc. All these chains make decisions in September, October to bring in product for next year, and that's what we're really gearing up for. One of the big wins we had recently was through Gamma, which is a buying cooperative of a bunch of different gas stations across Central Texas. We were recently approved for 700 accounts in Central Texas through that group. So just looking at our cost breakdown right now, we're currently producing the can at $1.15, and we're selling to our distributor at $1.57. That's not a great gross margin. That's about 28 points. However, there's a very clear path to getting this down to about 49 points pretty quickly. Volume is going to be a huge driver for us. Moving to printed cans saves a lot of money. And we recently just partnered with a co-packer here outside of Austin that can make the product cheaper for us. We're on the shelf at $2.99 as well. So on the marketing side, we've really focused on certain niches we can go after. Being a small brand, you have to focus on things that have a strong community, strong word of mouth. We can't, focus on these kind of high and mighty things that mass market brands have all the money to go after. So without spending $1 on digital ads, over the course of March to June, we generated 1.5 million impressions on Instagram through our partnerships with All Day Running, Outdoor Voices, Recess Pickleball, cycling clubs, running clubs, etc. We've built great partnerships with what we call friends of the brand, people that are kind of micro to macro influencers on social media. And we're really starting to figure out that, hey, this is resonating with people that are into CrossFit, running, pickleball, and starting to hone in on that target audience. So activity for the rest of this year. We're going to continue to accelerate our velocity in store in Texas and Tennessee, currently in 250 accounts, and that's growing pretty rapidly at this point. We're focused on getting this big chain account to land, and that's where we can really start to leverage the distributor network who has hundreds of sales reps, out in the market every single day. We plan on raising a Series A next year to get us over to that next hump. And as we're thinking about market expansion and where to go next, all these chain meetings that we're having right now are going to drive that, so that we're launching markets with already 200 stores or more ready to go, as opposed to trying to slowly grow those account numbers. Currently, we're on pace to do 850K this year and finish at about 1,200 accounts. But really, this is all about getting ready for next year. So by having some of those chain mandates that I talked about, getting to 5.5 is extremely realistic. And then a big jump in 2025, using some of that Series A capital to continue to grow. The reason I know these numbers are possible is because I did it in the past with BioLite. And so these aren't a stretch. This isn't, doing anything crazy. And the reason why we're focused on this getting to kind of $20 million is because we know that's what beverage conglomerates are looking at to acquire a brand in this space. We're not trying to be a billion-dollar company. We're trying to grow this thing quickly to $20 million, hyper regional, go deep, not wide, so that a beverage conglomerate can buy us, roll us out nationally, and make their money back within 6 months. So we're currently using a safe funding. We've had about 65% of that 1.5 committed. We are aiming to have this closed within the next 30 days, just to continue to fund some of the growth that we're experiencing. We plan on using that money for inventory needs, to continue to hire sales reps in key markets, selling expenses like POS, slotting fees, promos, et cetera, and then marketing the product, using some of the things that we're learning to continually just get more and more efficient on how we're presenting the product. Any questions?
We had some questions in the chat box, but before we get into that, what do you see as the work with the likely exit opportunities? Who you think would be the most likely candidate to buy you?
Yeah, so a lot of alcohol companies are seeing trends in alcohol. They know they're going down. They're starting to diversify and getting to NAs. So we feel confident that somebody like a Miller Coors or an Anheuser-Busch would be interested in this brand. There's also conglomerates out there like KDP, plenty of people outside of kind of the Pepsi and Coke to participate in a brand like this.
Great. And I believe you have some great opportunities coming up with some of the bigger grocery stores. Can you tell us more about those?
Yeah, so like I mentioned, we're in talks with HEB right now. They're big fans of the product because we are based here in Texas. There's not really any other Texas, hydration drinks. HEB is king down here. If we get into that, that opens the floodgates. The most interesting things that have happened recently, we've had Nike headquarters and Facebook headquarters reach out this past week. They want to bring in the product, start stocking at their campuses because we're in a can. It's a differentiator, and we are skating to where the puck is going right now.
Great. And from the audience, well, the first question is, Prime is highly criticized. How are you immune from those same criticisms?
Yeah, so Prime, they've gotten a lot of flack for their caffeine product. We kind of compete more with their sports drink. The problem with their sports drink is it's got sucralose in there, and their electrolyte ratio really doesn't work. So there's not a whole lot of science backing that product. They've just done a great job of marketing to teens on TikTok.
Next question is, how many SKUs do you have?
Currently have 3 flavors in 16-ounce cans. We plan to extend, our product either through new flavors, different packaging formats, whether it's like powder or 12-ounce can.
Great. And what are your plans? What do you do for advertising right now?
Yeah, so a lot of cans in hands. That's how you get things off on the ground in the early days. We're starting to build partnerships with different fitness influencers, runner influencers, et cetera. But at the end of the day, we got to get out there where people are sweating, where people are dehydrated, and win people over by trying over the product.
Are you trying TikTok for the advertising or no?
We, as adverse as I am to TikTok, we are. It's a great way to build awareness around something.
Great. And what valuation are you raising those funds on currently?
Yeah, so our safe, the cap is at 10 million.
10 million. Great. Any other questions from the audience? I think we're near the end of our time here. I think with that, I guess my last question is, what was your category growth rate? How fast is this sector growing?
Yeah, hydration as a whole is growing at 11% a year.
Okay, great. Sound like it's a good market and it's doing very well. I think we're at the end of our time. I want to thank you, Jordan, for your presentation. And we've sent a poll out for those in the audience. If you've answered that, we'll be able to get you in touch with the founder on this one. And with that, I think we're at the end of our session today. I want to thank all of our panelists that spoke, that Chris and Jordan, as well as the family office panelists, David, Kevin, and Eric. Thank you guys for a great presentation, great content. We did record it, so if anybody needs that, let us know. And with that, we'll go ahead and close it out for today, and we'll be back soon for another family office panel. With that, we'll wish you guys a good afternoon and see you next time. Have a good one.